I'm Ross. I'm from the Zikling Online Learning and Evaluation Center. Okay, and I'm on the team. I'm in charge of your finance SAM. Okay, and I'm also teaching a FIN3000 course. Okay, currently. So today I'll be running this review session on Chapter 2 to Chapter 5. Okay, if you have any questions in the meantime, ask away. Okay, we'll start with Chapter 2. Okay. I'll put a major time on Chapter 5, okay? The focus is on Chapter 5, okay? So Chapter 2, 3, 4, I'll go through very quickly, okay? All right, so let's start. So Chapter 2 is about financial markets and institutions, okay? Let's run through some key concepts, right? A financial market is a market where securities are issued and traded, okay? So by categorization and criteria, we can see whether the security is newly issued. We categorize the financial market into a primary market and secondary market, right? Then by the security nature, we have equity market, fixed income market, okay, derivatives market, all right, foreign exchange markets, and commodity markets, okay? That's what kind of securities are traded in each of the markets, okay? So by maturity of the security, okay, we have capital markets, that's long-term, mostly more than 1 year, and the money market, okay? That's a short-term market, less than 1 year, okay? One example could be treasury bills, okay? All right, commercial paper, okay? So in this Chapter 2, we have two key concepts, okay? The first one is a financial intermediary. That's an organization that raises money from investors and provides financing for individuals. Yes?
Will you upload this presentation into Blackboard?
Oh, yes. Sorry, I didn't forget. I didn't mention that, okay? So afterwards, the answers to the questions, okay, and these slides will be uploaded, okay? So don't worry about it, okay? But I still want next time, for this time, it's okay. Next time, before you come, okay, you will see these questions under the same, okay, the Blackboard, right? Some of you have already seen them. So review the questions before you come, okay? That'll be more effective. Okay, any other questions? No? Yeah, okay. So the financial intermediary, okay, in a layman's term, can be considered as a middleman, right? So moving money from investors to corporations to projects, okay? So here are some typical financial intermediary. Mutual fund. Mutual fund is an investment company that pools savings of many investors and invests in portfolio of securities, okay? They have low-cost diversification and professional management. Okay, they pick good stocks to beat the market. Okay, the fee they charge is a percentage of the portfolio value, and investors are not necessarily wealthy. Okay, so the entry barrier for mutual fund is very low. Okay, retail investors, small investors, big companies, okay, institutions, they all can invest in mutual fund. Okay, but a hedge fund is a private investment fund that pursues complex, high-risk investment strategies, okay? So they're the risk-seeking investors, okay? And these institutions usually have high returns, okay? So by the description of the hedge fund, okay, hedge fund has a higher entry barrier, okay? It's usually institutions and very wealthy investors, okay? So individuals, so retail investors usually do not participate in hedge funds, okay? All right. A pension fund is a fund set up by employer to provide employees' retirements. Okay, so pension fund uses employers' retirement fund money to invest. Okay, so they're seeking some safe investments. Okay, so they're designed for long-run investment and they have a tax advantage. All right, so on the pension fund, usually the capital gains tax is not charged. Okay, so a pension fund has tax advantages. Okay, they're usually not taxed by capital gains tax. Okay, all right. So move along. So instead of a financial intermediary, there's a financial institution. Okay, so financial institution does more than just pooling invest savings. Okay, commercial banks, insurance companies, investment banks. Okay, they do contractings. Okay, they do depositories. Okay, so they raise financing in special ways, deposits or selling policy insurances, insurance policies, okay? They provide additional financial services, okay? And they not only invest in securities, but also lend money direct to individuals, business, or other organizations, okay? So financial institution does more than financial intermediary, okay? So that's a bit difference over there, okay? So typical financial institutions include commercial banks, the major source of loans for corporations, okay? investment banks. Okay. On the right, they issue the stocks for the companies. Okay. Also, we have insurance companies. They sell insurance policies. They also do investments. Okay. All right. So the functions of financial markets and intermediaries. Okay. First, they transport cash across time. Okay. So when investment comes, the opportunities, investors want to invest. Okay. But they do not match all the time perfectly. Right. Investment can come next year, but some investors already hold cash. They want to save, right? They want to invest. So financial market intermediaries, they can transport cash over time. They can do risk transfer and diversification. Okay. They also provide liquidity. Okay. The payment mechanism is usually understood as, the cashing and out. So also, there's another important thing, which is information. Okay. So price, as usually understood, is how expensive or how much one good or asset could be paid for. But price also provide information, right? The market price. Okay. They provide information about the firm's future investment and opportunities, growth. Okay. So we'll talk a little bit more about that in the market value later. Okay. So the financial market, okay, like exchanges, they offer you the security prices, right? Stock prices. Okay. Those prices will give you information about how the market, right, judge or value the stock. Okay. Okay. So this is a pretty important graph. Okay, in your chapter 2. Okay, I believe you should have access to these slides by your professor. Okay, this graph you should have seen it before, or when you're learning chapter 2. Okay, so this graph is the fund flow of the financial market, institutions, and corporations, investors. Okay, so the money ultimately all come from investors worldwide. All right, so the money can flow into the financial markets or financial institutions. Okay, the investors can choose to directly invest in stocks, bonds. Okay, or they can give the money to the financial institutions or intermediaries and ask them to invest for the investors. Okay, but you need to understand that the cash flows ultimately come from here, and they all end up in there. Okay. Okay, so without the investors and corporations, financial intermediaries, financial markets, okay, institutions, they have no source and no outlets. Okay, so in this one, you can see financial market and financial institution, they also have some interactions. Okay, institutions also invest in the equity market, right? They buy stocks, they form portfolios. Okay, so that's the fund flow, okay, of the whole finance world. Okay. So the takeaway is that investors worldwide inject cash into this, and then they do business over there. Okay? So investors can choose directly go to the financial market, buy stocks, bonds, or okay, they detour a little bit. Okay? Because these people, okay, if you're not very experienced in investing, you might as well just trust some investing wealth managers or professional investors to invest for you. Okay? So they take some profit from your money, I understand, but you also gain some profits, right? Instead of you buying stock, maybe losing, right? Okay. Any questions so far? No? Okay. All right. So let's see some questions in chapter 2. Okay. So when we are doing these questions, okay, first thing I want you to do is to read the question carefully. Okay. That's always very important. Okay. Do not read halfway and then start to pick the choices. Okay? So the primary distinction between securities sold in the primary and secondary market is what? So the primary market is when the new securities are issued. Okay? Secondary market is where the already issued securities are traded. Okay? So the key distinction between the primary and the secondary market is whether the securities are newly or already exist. The answer is C. Okay? That's the key distinction between the primary and secondary markets. Okay? So when a company does an IPO, okay, it's in the primary market first, right? IPO, initial public offering, that's when the company first sold their shares publicly. Okay? So they do it in the primary market, and then the shares go to the secondary market. People can trade the shares there. Okay? All right. Second, corporate financing comes ultimately from, okay? So this is a point I just mentioned, right? The financing ultimately comes from the savings by household and foreign investors, okay? So it's when the savings and foreign investors, they have the money, they inject the cash into the market, right? Then makes the whole finance world run, okay, and operates, okay? All right. Which one of this is a money market security, okay? So money market security. Okay, money market is a market where short-term investments are there, right? Usually less than 1 year. So commercial paper is the one, okay? Usually for common stock, a 2-year bond, a 20-year bond, these are all more than 1 year of investments, okay? Okay. Which of the following is typically not considered a function of financial intermediaries? Okay, investing in real assets. Okay. So, we know that the functions of the financial intermediary could be providing a payment mechanism. Okay, they accumulate funds from small investors, spreading or pooling risk among individuals. Okay, investing in real assets is usually the function or what the firm does. Okay, corporation do. Okay, all right. So the answer is B. Is not. Remember here, right? Okay. Yes.
So the B is not investing in financial assets.
In real assets, right? Okay. Companies could also invest in financial assets. That's correct, right? But here we're still talking about real assets. Okay. All right. Good. Okay. Yeah. One reason suggesting that banks may be better than individuals at matching lenders and borrowers is that banks. Okay. So, why banks are better at matching lenders and borrowers instead of individuals, right? Okay. So, consider this: if a company needs to borrow money, what will the company do? Stand in the street and ask everybody passing by, say, can you give me $500? I'll give you one of my corporate bond, okay? Or the company will go to an institution and say, okay, help me issue $1 billion worth of corporate bonds, okay? What will they do, right? And also, if you're the investor, would you trust the company standing in the street and say, give me $500, I'll give you one corporate bond? No, not so much, okay? So the bridge function of the financial institutions, okay, is offering some creditworthiness, right, to both sides, okay? And also, banks might know better about this company than you, right? They have a whole team of firm evaluation, right? They can go in and evaluate. That takes a lot of time for you if you want to do it individually, okay? So the bank have more information to evaluate the creditness, and also there's trust, right, on both sides about using a financial institution, okay? So here the answer is D, okay? Okay. So which of the functions does not require financial markets? Okay. So the answer is A, retention of cash by corporations, okay? So if you see how cash flows into the company and out of the company, you can see that investors inject cash, right? Then the financial manager, okay, puts money into firm operations, real assets, okay? And then they generate profits coming back to this firm financial manager again. There are two options that the manager can choose, right? Okay, either give some money back to the investors or retain some money back into the firm, okay? So the 4B is the dividends, and the 4A is the retained earnings, okay? Do managers need the financial market to retain their earnings? Okay, not so much. But the other choice is provision of liquidity, risk reduction by investment, of diversification, okay? Provision of price information. Those are the functions of the financial market, and they do need the financial market to give those functions, okay? But retaining their earnings, okay, does not need the financial market to do for the firm, okay? All right, any questions? Good. Okay, so the opportunity cost of capital, okay? So in the chapter 2, if you see your slides, you will see a graph like this, okay? When cash is injected into the firm, there are basically two choices that the manager faces, okay? Either invest with those cash or give the money back to the shareholders, okay? Especially when a firm is operating, right? in the projects, and then the profits of the project come back to the financial managers of the firm, then they face a choice of whether to do this or that, or how much they do. Okay? So what's the rule of thumb here that the firm should give money back to the investors or keep in the company to invest? Yes?
It must be greater than the minimum amount that they can get from investing the money themselves.
Yeah, very good. Okay? So thinking about this, right? The firm is owned by the shareholders. Managers are trying to maximize shareholders' wealth. Okay? So if the shareholders can get 10% with that money, but in the next project, the firm is only getting 5%, would the manager do it? No, right? Giving back the money to the shareholders, they get 10% on their own, right? Okay, I keep the money, I invest for my shareholders, I get 5%. Which one's better? Giving the money back. Okay? So the return that shareholders can earn on their investments themselves is the opportunity cost of their capital, right? So if they can get 10%, the firm has to do better than the 10% to keep the money and invest, right? Otherwise, your shareholders wouldn't even agree for you to use the money to invest, right? They would require the money to be returned back to themselves, okay? So the opportunity cost of capital is what the shareholders can get with that part of money. If they're trying to invest in this firm, you gotta do better, right? So the rule of thumb here is your investment returns should be at least more than your minimum acceptable rate of return, okay? So the cost of capital, the opportunity cost of capital is the minimum acceptable rate of return of a project, okay? That's the cost of opportunity cost of capital, okay? All right, so let's see that one, okay? So for example, A is the interest rate that firm pays on a loan from a financial institution, not necessarily, okay? Firms also have what? Equity financing, right? It's not the maximum, okay? And it's not always 10% or less than 10%, okay? That's different for each individual firms, okay? So it's not always less than 10%. Okay. So excess cash held by a firm should be, okay? This is the same question with a different kind of different writing. So we know that the cash should be returned unless you can get better investment opportunities on the left-hand side, right? Okay, so this should be reinvested by the firm in projects offering rates of return higher than the cost of capital. Okay, otherwise this should be returned back to the investors. Okay, same question. Okay, which one of these parties cannot invest in a hedge fund? As I said, hedge fund has a very high entry barrier, right? Okay, so small retail investors usually do not participate and cannot invest in hedge funds. Okay. The other three, they can, right? They're holding a lot of money and they can invest in the hedge fund, okay? Usually small retail investors cannot. Okay. Okay. Which one of these parties can invest in a mutual fund? Okay, mutual fund has a lower entry barrier, right? So all these small retail investors, B insurance companies, C wealthy individuals, they can all invest in a mutual fund, okay? So mutual fund has a lower entry barrier. Okay. Which one of the following funds provide tax advantages to individual investors? Pension funds, right? There's no capital gains tax on the pension funds. Okay. So they accumulate better. So that's a tax advantage. Okay. Okay. So that's chapter 2. Okay. All right. So for those who come in later, okay, the focus of today is chapter 5. Okay, so chapter 2, 3, 4, I will go a little bit quicker. Okay, all right. So chapter 3, accounting and finance. Okay. I don't have handouts. Yeah. You can access the questions online in your SAM. Okay. All right. Good. Chapter 3, accounting and finance. Okay. Accounting is quite important. Okay, that's one of your prerequisites before coming to the FIN3000 class. Okay, you need to understand those financial statements to do finance, right? Okay, so here we have some key concepts for accounting in chapter 3, okay? A balance sheet is a financial statement that shows firm's assets, liabilities at a particular time, okay? You have assets, you have, yes? What's that? I'm going through key concepts in chapter 3. So the questions will come afterwards. Okay? The last question was 11. Yeah? Okay? So great. Okay, then you have assets, liabilities, common size balance sheet. A lot of items. Okay? But I hope when you're thinking of balance sheet, you think of this first. Okay? You don't think of individual items, but you think of this structure first. What do I mean? I want you to think of a balance sheet to start with assets, liabilities, and shareholders' equity. That's the biggest 3 parts of your balance sheet. Okay? Assets is on the left, shareholders, total liabilities on the right, okay, right top, and shareholders' equity on the right bottom. Okay? Why is it called a balance sheet? Because it's balanced, right? It's balanced. That's the name stands for, right? You have assets on the left-hand side. They add up to a number over there. You have liabilities and shareholders' equity. They add up to a number over there. Okay? If you have a good accountant, those 2 numbers match. Okay? If those 2 numbers don't match, fire your accountants. Okay? All right. Then once you have that big structure, okay, now you start thinking about why we form this balance sheet, right? So on the left-hand side is what the firm has. Okay? Where does the firm use all the money, all the funding, okay, to acquire all the assets? Okay? Either it's current assets, fixed assets, doesn't matter. That's where the company has purchased, owned, okay, spend all the funding, okay? On the right-hand side is where the company gets their funding, okay? They get it either from what? Borrowing money on the right top, or what? Selling shares, selling ownership on the right bottom, okay? So it's on the right-hand side, money you acquired from the market. On the left-hand side, money you have used, right? So by principle, you should be even, right? You use all the money you have to purchase all the assets you have, okay? There shouldn't be an extra cent that you didn't use, okay? Or you're owning some money, okay? All the money you have raised on the right-hand side should be equal to all the assets you have purchased or own on the left-hand side, okay? I mean, when I'm talking about assets, I'm also talking about current assets, fixed assets, right? There could be cash and securities. You would say, oh, some money is left on the firm's account. That's OK. You can put in the cash, right? That's your cash holding, right? You have some cash. You haven't purchased anything yet. You're keeping some liquidity on your balance sheet. That's OK, all right? But you can't have an unbalanced balance sheet, OK? All right. Then you can see, okay, assets represent the use of the fund raised. Okay, you have current assets, long-term fixed assets. Okay, either tangible or intangible. Okay, so who can give me a good example of intangible assets? What?
Tangible assets?
No, intangible assets. Goodwill, patents, right?
Trademarks?
Okay. Yes, trademarks and things, right? They're not tangible. Okay, you can't touch them, right? Okay. Okay, good. Okay, so the structure of the balance sheet, I like you to know that first before you dig into all the small items in between. Okay, if you start with the small items and come back to the big picture, that's the inverse order, and in that way, it's not so easy to figure out. Okay, all right. Then we have another type of balance sheet, which is common size balance sheet over here. Right. So common size balance sheet. One key thing to remember is every number is in a percentage of the total assets. Okay? I mean, I know total assets equal to total liabilities plus shareholders' equity. Okay? All right? Okay. Okay, so net working capital. Okay? Current assets minus current liabilities. Okay? So the net working capital roughly measures the company's potential reservoir of cash. Okay? Because the current assets is how much liquid asset you have on your balance sheet, right? Relatively speaking, liquid. Excuse me. Your current liabilities is what? It's the amount of cash or payments you need to pay in a short time, right? So your amount of liquid assets minus amount you're about to pay, okay? The net amount is what? Is how much net liquid asset you can have, right? Because you're about to pay that much very, very soon, okay? So excluding those, we can see how much of liquid asset you're keeping on your balance sheet, okay? So that's the net working capital, okay? Okay, so here, that's a good thing. All the financial statements, balance sheet, okay, the income statement and the cash flow statement we'll see later, okay, record the book value of assets. What does it mean by the book value of the assets? Okay, yeah.
Whatever I put into the company.
Okay, whatever I put in the company, and that's a past tense, right? So it's historical, okay? Book value usually is associated with this word, historical, or original values. Is what's the value of the investment that investor put into the company, okay? Now what about market value? Okay, a good example is a stock price, okay, right? Stock price increases over time for most of the companies, right? That's the market value, okay? So they measure the current value of the assets and liabilities, and that current value is what? Measured by the market, okay? So you can say that my book price per share is $20 per share, okay? That $20 per share means what? My shareholders' equity divided by my shares outstanding, okay? That's my historical equity investors' investment per share, okay? But how much is that worth? Okay, on the market, it could be 100. Why? Because market investors think, oh, I think this company has a great growth opportunity, so it's worth $100 per share, okay? So while book value is usually associated with historical original, market value is usually associated with what? The future, okay? Great, okay? The future, okay? The growth opportunities, okay? All right. Okay, so income statement, right? So income statement is a financial statement that shows revenue, expenses, net income of a firm over a period of time, okay? We have a common size income statement as well. It's a percentage of the revenues, okay? Revenues is also called earnings. No, not earnings, sales, sorry, okay? Revenue is also called sales, right? Okay, great. So when we are looking at the income statement, I still want you to look at the big picture first instead of individual items, okay? If you remember income statement, usually you do, oh, sales minus blah, 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 okay? But what I want you to understand first is, first of all, this part before the EBIT, okay? The earnings before income, interest, income, tax is what? It's all your operations, right? You're using your revenue or sales minus all the real operations costs, okay? Then you get to earnings before interest and income taxes, okay? Then after that, we deduct interest, tax, and then we reach net income. So you can see that things we deduct here has a little bit different than things we deduct here, okay? Those are from your real operations, right? Cost of goods sold, all the expenses you have paid for selling general administrative things, okay? Depreciation, right? But here we're deducting interest expense. So first we deduct the cost of the real operations, and then we deduct the cost of financing. You can see there's a little bit different, right? Because interest expense is what you pay on what? On your borrowings, on your debt, right? You borrow money, you pay interest, okay? That part of the money is not associated with your real operations, but is associated with your financing, okay? So the two parts serve a different purpose, okay? All right. So there's one interesting item, which is earnings before interest and income taxes, okay? I want you to pay attention to the item specifically, okay? And the meaning is in the name, okay? Why? Because it says interest first, then tax. Okay? That's the right order. You deduct interest expense first, and then you deduct tax. Why is that important? Very good. He's from my class, okay? Yeah, we've gone through this, okay? Interest is tax deductible. And that's a very important feature, okay, of accounting for corporates, okay? So after you deduct interest, you reach taxable income, okay? Then your tax first, this corporate tax is taxed based on this taxable income. Okay? Then you reach net income. Okay? Net income is also called earnings. Okay? So there are different names for that. Okay? So your net income will be separated into dividends and addition to retained earnings. Okay? Dividends will be what? Giving back to the investors, right? That's how much we're distributing the dividends back to the investors. The cash flow we give back to the investors. Okay? Then the retained earnings will be retained in what? Shareholders' equity. Okay? Now on the balance sheet, you will see that in the shareholders' equity, okay, you will see retained earnings. Okay? All right. Okay? So that's the income statement. Okay? So you can see this is a regular income statement. This is a common size income statement. Okay? It's every number is a percentage of the net sales or revenue. Okay? All right. We good? Okay. Statement of cash flows is a financial statement that shows firms' cash receipts and cash payments over a period of time. Okay? Cash is a little bit different from income based on two things. Okay? Depreciation and cash versus accrual accounting. Okay? So let's take a look at the cash flow statements. Okay? We usually have three parts. Okay? Cash flow provided by operations, cash flow provided by investments, and cash provided by financing activities. Okay? Those three things, okay, measure the cash flow changes from three parts of the company. Okay? Generally speaking, this cash flow by operations, okay, real operations, investment, that's capital budgeting, and this is what? Financing. Okay? So here, a specific item here is depreciation, which is in cash flow by operations, right? Because you can see that in the income statement, it's the same, right? It's in the first part of the income statement. Okay? So that's by real operations. Okay? Okay. Then once you calculate all the cash flows, okay, from three parts, then you reach a net increase or decrease in cash and cash equivalents here, this number. Okay? So this number is associated with an item in your balance sheet. This one. Okay? The net change of your cash in a company should be the net change in your cash holdings. Okay? So the cash flow statement is associated with the balance sheet here. So the number you calculate at the end of the cash flow statement, which is the sum of the three cash flow from operations, investments, and financing, okay, should be the same as your cash and securities change from last year to this year. Okay? You either add cash to your cash holdings or you reduce cash from your cash holdings. Okay? And the income statement has association with the balance sheet here, right, with the retained earnings. Okay? So the three financial balance statements, although they are giving you different pictures of the item of the company, okay, they're connected in some way. Okay, and that's the connection. Cash flow statements is connected to the cash and securities here. Income statement is connected to the shareholders' equity here. Okay. 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 So in cash flow, we have a free cash flow that in finance we care a lot about. Okay? Free cash flow is the cash available for distribution to investors after firm pays for new investments or addition to the net working capital. Free cash flow is the cash flow from operations minus your capital expenditures. Okay? So in detailed items is net income plus interest plus depreciation minus additions to net working income and minus capital expenditures. So you can see that from in Chapter 3, we talk about cash flow, and then in Chapter 5, we start to discount cash flow. Okay? Usually the discounted cash flow is the free cash flows for firms. Okay? Maybe not for assets, but for firms. Okay? So free cash flow is available to be paid out to investors as interest and dividends, or to be repaid debts or pay back stock. Okay? So free cash flow is how much cash flow the firm can generate to do their operations or financings or pay back their financing costs. Okay? Okay. All right, so let's see some questions. Okay, we're on question 12. Okay? All right. All right. companies usually buy what? Real assets. Okay? These include both tangible assets such as what? Machine, great. Okay? And intangible assets such as trademarks, patents, okay? Goodwill. To pay for these assets, they raise capital. The decision is about how to raise money is usually termed as what? The decision about how to raise money is usually termed what? Financing or capital budgeting? Financing. Okay? Capital budgeting is about what? What to invest? Right? Which project to invest? Right? Okay? Assume a firm increases revenue by $200. Okay, we're just using dollars here. Okay, while increasing its cost of goods sold by $150. Okay, how much additional earnings before interest and tax will the firm have if its tax rate is 35%? Okay, so read the whole question carefully. Okay, do not stop halfway and start doing the question, please. Okay, all right. So to solve this problem, first of all, when we're reading this question, answer me this. Does EBIT has anything to do with corporate tax? Does earnings before interest and tax, the EBIT, okay, has anything to do with corporate tax? Let's rewind a bit, okay? This is where EBIT is. This is where the corporate tax is. Okay? I mean, they have some association of determining how much tax you have to pay later, right? But to calculate EBIT, we never reach tax, right? Tax is after, okay? So even here, it's very generous. It gives you a 35% corporate tax. It's hardly going to be used in calculating this EBIT, okay? So that's a redundant information in this question, okay? So you have a $200 increase in the sales and revenue. You have a $150 increase in the cost of goods sold. Okay? So what kind of mathematical operations we do with those two to get EBIT? Yes? You subtract, right? So you have an increase in sales and revenue. You have an increase in cost of goods sold. Okay? So to get EBIT, we use sales or revenue minus cost of goods sold minus expenses minus depreciation, right? So there will be a net $50 increase in EBIT. Okay? We never use that corporate tax thing. Okay? All right. So the answer is B. Okay? $50. Okay. So this is a very good example of what I said before, the big picture thing. Okay? So if the balance sheet of a firm indicates that the sum of total liabilities and shareholders' equity, okay, that's the right-hand side. Okay? So when you are reading until here, what's immediately in your mind? That's the right-hand side of the balance sheet. Okay? Right? The sum of the total liabilities and shareholders' equity, right? That's the right-hand side. Okay? So what does the right-hand side equal to? The left-hand side. Exactly. That's the balance sheet, right? Okay. So keep reading. Exceeds the sum of current assets and tangible assets, then what? That's the right-hand side. That's the left-hand side. Okay? Theoretically, they equal. So this part and this part are equal. Now this part exceeds this part plus the tangible assets. So what's happening? Or what do I do to make them equal? Yeah, I have to add some intangible assets, or the intangible assets are not zero, right? Otherwise, they should equal. Okay? So there's some intangible assets. Then the firm has brand value or patent value. Those are in the intangible assets. Okay? All right? So first you establish that the two parts are equal. And then you find out for some of the terms, they add up, but they're a little less of what's on the right-hand side. Then you see, oh, there should be something still there, right, to make the equation equal. Okay? And that's intangible assets. Any questions so far about this? Good? Okay, number 15. What's the most straightforward financial report you can refer to if you want to study the relative change in firms' cash holdings? Okay. It's a very good question, all right? You look at cash holding, you say, oh, cash flow statements. That's it, done. Two things, okay? change in firm's cash holdings. There are two parts you can find that, all right? Either at the end of the cash flow statement or the cash holdings of a firm's balance sheet, right? Okay? So far, cash flow statement is still a very good candidate for this answer, okay, for this question. But there's another word. What's relative? Okay, relation, okay? Okay, relative, absolute. Dollar values, percentage values, okay? So here, the relative change is a percentage instead of a real dollar term. So here, we're looking for some statement that gives you the relative or percentage change instead of the absolute change. And which one is it? It should be a common size thing. If it's common size balance sheet, great, okay? But the statement of cash flow gives you what? The real dollars term, right? It doesn't give you the percentage, okay? Good, okay? So it's a common size balance sheet, okay?
Balance sheet and regular balance sheet.
Great, great question. Let's rewind a bit, okay? A balance sheet gives you the real dollar amount, okay, in each item. But what does a common size balance sheet do? Every item is in the percentage of the total assets. Basically, you divide every number by the number of total assets and acquire a percentage term. Okay, that's a common size balance sheet. You good? No problem. Okay. Number 16, which one of the following is an intangible asset? Goodwill, right? Okay. If you see this on your test, you're blessed, right? This is a free given question, right? Grab the question, okay? Don't tremble your hand and scratch the wrong, okay? Answer, okay? Goodwill, okay? All right. Net working capital is a measure of company's, okay, estimated cash reservoir, right? Okay, how much net liquid asset the company has, okay, or cash, right? Okay. A balance sheet may be considered backward-looking from the perspective that it's, okay? Backward-looking. What's backward-looking? Historical, right? Because the balance sheet records the book value of the assets, which is associated with what? Historical, okay? Value of the assets, okay? The answer is B. Records historic, not current values, okay? Current values is what? Market value, right? That looks at the future operations and growth opportunities of the firm, okay? Market value balance sheets differ from book value balance sheets in that market values, what? Market value balance sheets do what? Okay? I mean, market value balance sheet record market value. But who determines market value? Investors, right? They trade on their exchanges, right? Supply, demand, there's a price, okay? So that reflects investors' expectations, okay? Generally speaking, market value should be higher than the book value for most of the firms, okay? But that's not necessarily true, okay? Some of the firms' market value are actually lower than their book value, okay? Yeah, but most of the firms do, yes?
That means they're doing pretty bad, actually.
Yeah, doing pretty bad, yes. Okay. Yes?
I just have a question about number 17.
Yeah, speak up a little bit. I want everybody to hear.
Question about number 17.
17, okay.
Ash reservoir, like what exactly is that?
You know what's a reservoir?
Yeah, I know. Like, is it just like
Yeah. So the net working capital, the concept, right, is basically telling you what's the net amount of liquid asset you have. You have, right? Current asset, it's defined as what? Current assets minus current liabilities, right? Okay. So what is current assets? Cash you hold, payments you're about to receive in a very short amount of time, right? Okay, right? Yeah, accounts receivables, right? So those cash can be considered what? How much you're holding. And those assets are pretty liquid, okay? What's current liabilities? Right, okay? A short-term payments, okay? Things you owe that have to be paid in the short term. Usually it's 1 year, right? Okay, so let's say you have $50 in your pocket. You're about to buy something that's $25. What does it mean by I'm using 50 minus that 25? Yeah, how much you have left over, right? Or how much cash you still have in your pocket. I know you have 50, but you're about to pay 25 in a very short time, okay? Then using 50 minus 25, you get another 25. What's that 25? That 25 is how much you still have left, okay? Although you have 50 now, okay? But to have a better estimate of how much you can still pay, right? I use current assets minus current liabilities, okay? And that's what's called cash reservoir, okay? Right? Okay? Any other questions? Yes.
So when would market value be bigger than book value, and when would market value be less than book value?
When?
Yeah.
Well, here. So book value is historical, right? It's how much you have purchased, how much investor has invested, right? That number is pretty stable, okay? That's historical. They invested this much, you can't change, okay? They invested $1 million, that's $1 million, okay? But when it comes to market value, it's determined by the market, right? It's when how investors think that your company is worth. Then basically you're asking the question, when do investors think your company is worth than more of the assets you're holding? Okay? It's when they think, okay, with this certain amount, let's say $2 billion of assets, you can create something better than $2 billion. Okay? Yeah, their expectations, right? It's like when producing an iPhone, basically they're using what? Metals, chips, and things, right? Those things are from what? Raw material, okay? Those things together cost you how much? Probably $200, that's it. But the iPhone is sold at $1,200 on the market. Why? Because investors think they're worth that much, right? When you sell a phone that's $1,200, people buy it. Why? Because they think they're worth it, okay? Do you think they know that's $200 to produce this phone? They know. But why they're willing to pay $1,200 to buy this phone? Right? That's also about the company. Your company holds $2 billion of assets. Sure. But why am I willing to pay $10 billion on stock prices for this company? Because I think it's worth it. Is it worth it now? Maybe not. But I think in the future, the company will produce, will make products that has big sales. Okay? That's their expectations. Yes?
So yeah, just to clarify then, market value reflects the investor expectations. You mean what they expect their share price to be valued at this moment plus the future projections?
It's future projections
Only?
valued at this moment.
Okay.
That's why we do discounted cash flows later. Right? Cash flows come in the future. They're discounted at this moment, and I determine the value. Okay? So that's why we do Chapter 5, Chapter 6, and Chapter 7. Okay? Those cash flow hasn't come yet, but I expect, oh, they're there. Okay? Then I'm calculating a present value for those cash flows about to come. Okay? So it's their expectations, right? Those cash flow hasn't come, but they're not realized yet. But still, we want to see, okay, how much they can be worth now. Okay? All right. We good? Okay. Which one of the following does not reduce a firm's net income? Net income is here. So what does not change the net income should come afterwards. Okay? It's the same thing as the EBIT and tax thing, right? So here is the dividends. Okay? Dividends comes after you determine your net income, how much you give back and how much you keep. Okay? Okay. Calculate the EBIT for a firm with $4 million total revenues, $3.5 million cost of goods sold, excuse me, $500,000 depreciation expense, and $120,000 interest expense. Okay? So this is still a question about knowing the income statement. Notice here that interest expense is after EBIT. So when you're calculating EBIT, interest expense is not calculated in there, right? Okay? So you use 3 items instead of the 4 given. Okay? Sometimes there are redundant items. You need to know the income statement pretty well for this question. Okay? So it's using the revenue, okay, $4 million minus $3.5 million of cost of goods sold and $500,000. Okay? And get your numbers consistent, okay? Sometimes they're using millions, but sometimes they are 500,000, okay? All right. So the answer is C, 0, okay? Current period depreciation expense is listed, okay, on the income statement, okay? It's not the investment section. It's which section? I mentioned a little bit before. Operations, okay? All right? So it's not the investment section of the cash flow statement, okay? All right. Double taxation, okay? Something you learn in probably chapter 1 about corporations, okay? Double taxation is a disadvantage on corporations. Why? Because the cash flows will be taxed first on the corporate level, and then when you're giving back the dividends, they're taxed again on the personal level, right? That's double taxation, okay? So here is a corporate tax, okay? Then once you give this money back to the investor, they're taxed again on their personal level, okay? So that's a double taxation. It's a disadvantage of the corporation, okay? So private companies, okay, usually sole proprietorship and partnerships, they don't have this, okay? All right. Okay, market price may be considered forward-looking from the perspective that it forecasts all the possible future operations and cash flows of the firm, okay? We have discussed about this already, okay? We good? Okay. Which of the following asset is likely to be considered the most liquid? Marketable securities. Why? It has a first rank on the balance sheet, right? You see that the left-hand side of the balance sheet is about assets. But how do we list those items? From the most liquid one to the least liquid one, right? Okay? So the marketable securities, okay, those are the most liquid one of the 4 choices, okay? What's more liquid than marketable securities? Cash, okay? All right, cash is the king, okay? All right. Okay, so that's the end of chapter 3, okay? So chapter 4, measuring corporate performance, okay? All right, we're doing fine. Usually in chapter 4, you will be overwhelmed by a lot of ratios, okay? There are a lot of constructions, a lot of ratios. Trust me, if we want to give you more ratios, we could. We can do all sorts of arrangements of different items in your balance sheet, income statement, and give you all kinds of ratios. But what are we doing here? We're not learning math. We're not learning fractions. What are we trying to do here? We're trying to learn finance, okay? We're learning finance, okay? Why did I say that? Because all the ratios have a meaning, okay? They serve some purpose, okay? They're not here just for us to give you a question to test you how do you punch your calculators. Okay? So here's my guidance. Okay? In chapter 4, always have this with you. This sheet, this slide. You should have that when the professor is posting the slides. Okay? That's the first slide of chapter 4. Okay? What do I mean? All the ratios serve a purpose, and you can see where that ratio is in this chart, where the purpose it serves. Okay? So the chapter 4 is titled Measuring Corporate Performance. Okay? So how do we measure corporate performance, right? All the ratios give you an angle of looking at the corporation and say, oh, at this angle, how is it doing? Is it doing fine? Is it doing better, okay, than other companies? Okay? So the biggest question is how much shareholders' value we have increased, right? And that's also the manager's object of running a corporation, which is what? Maximize corporates what? Shareholders what? Value, okay? I like the word value. It's not profit, okay? Value is more long-term, okay? So the biggest question is shareholders' value. How much it has been increased, okay, by this manager. Then now we separate into 2 parts. One is called investment, but one is called financing, okay? But those are about what? Investment is about what? Capital budgeting decision. Financing is financing decision. That's the 2 most important decisions that firm make, right? Financing decision, how much money we want to raise, okay? In what method we want to raise the money, okay? Capital budgeting, what kind of investment we're investing and how profitable they are, okay? So that's two of the company's decisions, right? So in capital budgeting, we're talking about profitability, we're talking about economic value added, we're talking about returns, okay? So in capital budgeting decision, we look at two specific things: efficiency of using the assets, which are the turnover ratios you have seen, and the profits, return on equity, return on assets, return on capital, okay? In the financing decision, how can the firm safely finance future growth? In the financing, we use debt and equity financing. That's the two external financing, right? So when we're using debt and equity financing, are you doing okay with your leverage? Are you using too much debt? Okay. Are you keeping sufficient liquidity? Okay. In your financing, right? So those questions follow from the financing decision. Okay. So when you're studying chapter 4, okay, with all the ratios and calculations, I don't want you to focus just the calculations, okay? Don't just remember those ratios, okay? Those ratios serve for meaning, okay? And the meaning is all in this graph, okay? Once you comprehend this graph, and when you're studying a ratio, think about where the ratio belongs, okay? Return on assets, here, right? Okay? Okay. Okay. So I'm not going to dig into the ratios and tell you the constructions, okay? You have those in your slides, okay? There's one thing I want to talk about is the DuPont system, okay? Sometimes you could be confused why we make one simple ratio complicated, right? ROA is after-tax operating income divided by assets. Why are we decomposing into two things? And return on equity is net income divided by equity, right? Is this single item here. Why do I want to make your life complicated into 4 items? Okay? What's that?
Might not always be given what the equity is or what the sales is.
Yeah, but that's not true in the real world, okay? When you read a 10K from a firm, you will always have those 2 items. Net income from what? Income statement. Shareholders' equity from the balance sheet, okay? Yeah, I know in your questions you might not know always net income and equity. You have these 4 and you multiply, okay? But why do we decompose though? I mean, in the real world, you see financial statements. You can calculate those items one by one, right? So this gives more information. You can see that for this certain amount of ROE, we have leverage, asset turnover, operating profit margin, and debt burden, okay? The leverage ratio and the debt burden is from the financing. These 2 are from the what? Investment, if you look at this, okay? So we decompose a ROE into 2 parts of the firm's big decisions and see what contributes to the ROE, okay? For example, if you have a 20% ROE, you can have what? Different values of those 4, right? So when we decompose, we want to see how the manager is actually managing to get this 20% return on equity, okay? It's not one measure anymore. It's a number consisting of 4, okay? And those 4 are associated with different parts of this company, okay? So that's what we're trying to do, okay? We're not trying to make your life harder, okay, by calculating. Okay, okay, so let's get into the questions, okay? If you want to pick a ratio to measure firm's profitability, which one is it, okay? So profitability, right, or here, is basically some returns, right, or economic value added. So profitability, here we have a measure that's what? ROA, right? Return on assets. What does quick ratio measure? Liquidity, okay? Opportunity cost of capital is what? It's the cost of financing, okay? It's in the financing one, okay? Time interest earned, okay? That's using EBIT divided by interest, okay? That's still what? Financing, okay? It's not about profitability, okay? A firm's quick ratio is equal to its current ratio, okay? This is like a mathematical question, right? Current ratio is current assets divided by current liabilities, but we know that current liabilities is consisted of cash, marketable securities, receivables, and inventory, okay? Quick ratio is what? cash plus marketable securities plus receivables divided by current liabilities, okay? If they're equal, what's the condition? This item is 0 for them to always be equal, right? Because all the three are the same. The denominator is the same, right? Okay? So the firm has no inventory, okay? A retail store with 0 net working capital may have, I'm sorry, I have an answer for you. I don't have a solution. No, that's not true. I wrote it for you, okay? Net working capital, 0, which means what? I'll upload this. Don't take photos. It's okay, okay? Focus on the material. Afterwards, you will see it in your SAM, okay? In the SAM, okay? Content, where you find that questions today, you will find this, okay? So focus on the material, okay? Don't get distracted by taking pictures. It's okay, all right? Net working capital is current assets minus current liabilities, okay, equal to 0, okay? Let's derive a little bit, okay? So you move current liability to the right-hand side of the equation, all right? You divide current liabilities on both hand side, that equals 1, right? So we decompose current asset into cash plus marketable securities plus receivables plus inventory. That's what we did before, right? Okay, now, this item equals 1, okay? Now the question asks, okay, so now let's think about quick ratio. Quick ratio is this item without the inventory, right? But inventory is a greater or equal to 0 item, okay? You either have no inventory or positive inventory, okay? So if we take that item out of this fraction, what's going to happen? I'm taking an item that's 0 or positive from the numerator, okay? So the value of this fraction should be less or equal to 1 because it was 1 before I took an item that's positive or 0 from the numerator, right? So the value of the fraction could decrease or not, but it could not increase, right? Okay? So the quick ratio is less or equal to 1. And let's take a look at the C and D, okay? Could it be 1.2? No, but it could be 0.8, right? A quick ratio of 0.8. Remember, the question reads, may have, okay? So it's not definitive, oh, it's 0.8. We're saying it could be 0.8, but it cannot be 1.2. That's what we're saying, okay? What about the inventory? Do we have information? No, okay? But we know that if net working capital is 0, then quick ratio cannot be more than 1. That's what we know, okay? That's using what we have to get what we know, okay? Do we know the inventory? Not much. We don't know much about the inventory. They could have inventory, could have not inventory. So, okay, all right? So the answer here is a quick ratio of 0.8, okay? Last year's return on equity was 30%. This year's return on equity has decreased to 20%. So far we have what? Last year return on equity 30%. This year return on equity 20%. What is return on equity? That's on you. What is return on equity? Net income divided by shareholders' equity. Okay? If you haven't learned this, it's okay. Once you learn chapter 4, you have this. Okay? So keep reading. Even though the firm's earnings equaled last year's earnings, what is earnings? What's the other name for earnings? Net income. Okay? The firm has no preferred stock. What causes the decrease? Okay? So let's structure it out. Here, return on equity T minus 1. I use that to represent last year. Okay? This year is T, last year is T minus 1. Okay? So return on equity T minus 1 is net income T minus 1 divided by shareholders' equity T minus 1. Okay? Return on equity T is net income this year divided by shareholders' equity this year. Okay? So you have a 30% and 20%. We good? Okay? Okay. Now we derive. Multiply shareholders' equity last year on both sides of this equation, we get this one. Okay? Do the same thing for this one. Okay, for the second one, okay? High school algebra, right? Okay. Another condition is given that the net income are equal for those 2 years, right? So the left-hand side of those two equations equal, which means what? The right-hand side of those two equations equal. That's why they're equations, right? They all equal to each other. So we have 0.3 times last year's shareholders' equity equals 0.2 times this year's shareholders' equity. Okay? Rearrange a bit. We have shareholders this year divided by shareholders last year is 0.3 divided by 0.2, or 1.5. If you don't trust my math, trust your calculator. Okay? So what does the 1.5 say? You can't do math, but we're learning finance. There's interpretation of the 1.5. What does it say? It says this year's shareholders' equity is 1.5 times of last year. Okay? So how much has your shareholders' equity increased? 50%, right? This year's shareholders' equity is 1.5 times of last year's shareholders' equity. So your shareholders' equity increased 50%. Okay? All right, so the answer is D. Okay, we good? Okay, well, firm's long-term debt equity ratio is 1.2, the firm. Okay. So the information given is long-term debt equity ratio is 1.2, which is what? Long-term debt divided by equity is 1.2. So long-term debt is 1.2 times equity. Okay? So all we have to do is what? Check the answers. Okay? So I checked the right answer B, which is what? Long-term debt ratio. What is long-term debt ratio? Long-term debt ratio is long-term debt divided by total cap. But total cap is what? Long-term debt plus equity. Okay? So long-term debt divided by long-term debt plus equity, that's the total. That's the long-term debt ratio. Okay? Then we can swap all the long-term debt by 1.2 times equity. Okay? Then you have 1.2 times equity in the numerator, 1.2 times equity plus another equity in the denominator. Okay? Okay? Then that's the best game or favorite game of yours, cancellation, right? You cancel the equity, you're left over with what? 1.2 divided by 1.2 plus 1. Okay? The answer goes to 0.55. So your long-term debt ratio is 0.55. Okay? Yeah. I'll upload, don't worry, okay? You don't need to take pictures. It's okay. Okay, so if you haven't learned chapter 4, I believe some of you haven't. That's okay. Use it as a preview. Okay? When you're learning chapter 4, you know what I'm doing here. Okay? Right. The current ratio is a proxy for what? Liquidity, right? Current assets divided by current liabilities. Okay? The current ratio is a proxy for liquidity. Okay? Measuring liquidity. How many times of your current asset is of your current liabilities? Okay? All right. Which one of those changes indicates an improvement on firm's asset management efficiency? Okay? So after you read this question, what are we trying to look for? We want to look for a measure that measures efficiency, and that measure better be increasing. Right? Which one of these situations give you a better situation that the firm's efficiency is changing, right? Increasing. Okay? So what's the good candidates for measuring efficiency? Turnovers, okay? Turnover ratios, okay? So let's take a look. A decrease in the average days in the inventory. Is that a good candidate? So to know that, what's average days in inventory? It's 365 divided by inventory turnover ratio. First of all, what's the 365? Yeah, great, okay? That's a trivia, okay? We're not going to tell you that, but you should know that, okay? So average days in inventory is 365 divided by inventory turnover ratio. Okay, so here, if I have a decrease in average days in the inventory, which is this fraction, right? This value is decreasing, means what? This value is increasing. Okay? An increase in the denominator makes the value of the fraction decrease, right? Because what? This is a fixed number. It doesn't change. Okay? So denominator increases, the value of the fraction decreases. Okay? So a decrease in average days in inventory means an increase in inventory turnover. That's a better efficiency. Okay? Now how do we understand this? An decrease in average days in inventory. That means your stock, your goods in your inventory stays less or stays shorter. What does it mean? That means they move out faster. That's increasing efficiency, right? Intuitively, that's correct. Okay? Your goods in your inventory stays shorter. They're moving out faster. Okay? So let's look at B. Okay? A decrease in the cost of goods sold while inventory remains the same. Okay? A decrease in the cost of goods sold, inventory remains the same. So the value of this fraction will decrease. This fraction, which is the inventory turnover ratio, decreased. That's not good. Okay? Right? We want a turnover ratio to increase, or the average days ratio to decrease. Okay? All right. Increase in the long-term debt ratio, that's not related, right? Long-term debt ratio is usually measuring what? Leverage, financing. Okay? Increase in the amount of assets while sales remains constant. So assets and sales can construct a ratio called asset turnover ratio. If that turnover ratio increases, that's good. That's also efficiency. Okay? But sales remain the same, but total assets increase, which means asset turnover ratio decreases. Okay? So that's not an increase in efficiency. Okay? It's a ratio for efficiency measure, but that condition is not an increase in efficiency. Okay? It's a decrease in efficiency. Okay. We good? Okay. Now the snoozing time's over. Okay? The real stuff is here. Okay? All right? Now pay attention. Okay? All right. Time value of money. You survive this, you survive FIN3000. Tell you the truth, okay? All right. First principle in time value of money, never compare cash flows occurring at different times without first discount them into common dates. By calculating present values, we see how much cash can be set aside today to pay for future bills. First principle, never do operations to different cash flows if they're not discounted to the same day or compounded to the same day. Second principle, don't get distracted in class. Okay? All right. So if it's a $200 next year and a $200 10 years later, okay, you cannot add them and say, oh, I have $400 today. That's not allowed. Okay? You have to discount them all to today and add them up and see how much money you have today. Okay? So suddenly, now, cash has another characteristic, which is time. Okay? Cash in $200 in cash 1 year from today is different from 10 years from today. Okay? So cash now has a time characteristic we have to consider. Okay? You can't just simply say, oh, I have $400 in my pocket now. That's not true. Okay? All right. Future value is amount which investment will grow after earnings interest. Present value is a value today of a future cash flow. Okay? So you can have a present value of $100. That $100 is in your pocket. Okay? It's current. All right? If you set aside or deposit in the bank, earn 2% interest a year, then at the end of the year, you will have what? $102, right? $100 is the principal, $2 is interest. You add them up, that's $102. But when will you receive that $102? Not today. The $102 is not in your pocket yet. Okay? That $102 happens in a year. That's a future value. Okay? When we're talking about present value, we have to be very, very specific. It's today, it's present, it's current. Okay? Any value that's not current is not a present value. Okay? Simple interest is interest earned only on the original investment or principal, if you will. No interest is earned on the interest. So here's a schedule of simple interest, okay? 6% interest rate, $100 first deposit. You earn $6 every year. There's no extra for you to earn. Every year, there's a $6 added to account. Done, okay? But compound interest is interest earned on interest, okay? Compounding interest, your next year's interest amount is depending on your last year's saving. But what do I mean? I mean this. You deposit 100, at the end of the first year, you have $106, right? Okay? Then next year, your interest depends on this amount instead of your initial amount, okay? So your interest starts to accumulate, okay? You start on earn interest on the interest, right? Because if it's simple interest, you have 112 here, but now you have 112 at 36 cents. Where does the 36 cents come from? It comes from 6% on that $6 interest, okay? This is compounding interest, okay? Compounding interest is not so powerful in a few years. You can see the difference is not that much. But if you do try, okay, you see that that's very, very powerful in 20 years, then 30 years, and 40 years, and 50 years, okay? So what do I say in class for compounding interest? What's the general principle? Live longer, okay? Live longer, you compound longer, okay? The more wealth you have, okay? Live longer, great. Okay, so how do we calculate compound interest, okay? So let's say that we have initial investment, that's the present value here, okay? That's at 100, okay? So the first year's total in your bank account is what? That present value plus the present value times the interest, right? Exactly the same thing we're doing here, okay? 100 plus what? 6% times 100. Together, 106, okay? But in math, we can use the distribute rule to put the 1 plus r together, okay? Then let's do one more year, okay? The future value of the second year should be depending on your future value of the first year, right? My total saving at the end of the first year, okay? Plus the saving times the interest, okay? Once we put it together, we can swap this first year's future value into a previous year's, okay? Then you can see the future value of the second year is actually your first saving times 1 plus r to the second power, okay? 1 plus r has been multiplied twice here, okay? Then, generally speaking, for t years, okay, compounding, we have present value times 1 plus r to the tth power, okay? So the future value by compounding from present value is present value times 1 plus interest rate raised to the tth power. The t stands for how many years or how many times compounded, okay? Now, high school algebra tells us we can do this, okay? We can have a future value to calculate the present value, okay? What's a good example of this? You want to spend $2,000 in 2 years, or you want to save $2,000 in 2 years. What should I set aside today on top of 6% interest rate? You can do that, okay? Great. This is doing compounding. This is doing what? Discounting, okay? Discounted cash flow is doing this. Although I know they are the same equation, okay? It's just rearrangement of items. But they stand for very different meanings, okay? It's the meanings that matter the most. That's when we're studying finance, okay? We're not studying math here, okay? Compounding and discounting, okay? That's more important. Okay, any questions so far about this? Okay, so the method of calculating present value by discounting future cash flows is called discounted cash flow method, okay? So the interest rate here is known as the discount rate, and the expression of that whole fraction is called discount factor, okay? Those are definitions, okay? Okay, why do we do discounted cash flows? That's a plural term. which means what? We don't only live 1 year, we live multiple years, right? Every year we have a cash flow in or out, okay? So the question can be a little bit complicated if we have more and more cash flows, right? But what's our general principle? To find the value of some future days of stream of cash flows, calculate the future value of each cash flow, and then add up to the future values, okay? So, so this is what I mean, okay? So let's ignore the annuity for a little bit, okay? You can have different cash flows coming in the future, okay? So how much are they worth today? Or a simple question. For your salary in the next 2 months, how much I can swipe my credit card today? Right? A question we ask ourselves every day, right? How much I can swipe now, right? To have enough to pay back later, right? I can't overswipe. I can't swipe for a helicopter today, not much, okay? But when I want to buy something, I always think, oh, if I swipe my credit card today, am I able to pay back later? Okay? And you know that the stream of cash flow in the future is not only 1 month of salary, right? You have multiple months of salary, right? If 1 month of salary is not able to cover this one, maybe the next one will come and cover it, right? Although you have to pay some interest, but still, right? If you want it really badly today, okay? Okay, so you discount multiple cash flows to today, and you can add them up, okay? So here, I'll introduce 2 specific assets first, okay? First one is the annuity, okay? Annuity is a very standardized and simple asset, okay? The annuity gives you this, same cash flow every year for a certain amount of years, okay? Here the 30 is arbitrary, I made it up, okay? It could be 20, it could be 40, okay? So we want to calculate the present value of the annuity, but when we're calculating the present value of the annuity, we're basically calculating what? The present value of each of these cash flows and add them up, okay? You said, no. This doesn't look like that. I know it doesn't look like that. It's a simplified equation, okay? So the present value of the cash annuity, remember, when I'm saying annuity, the first one always happens in the first year, okay? Then keep going. Is using that cash payments times 1 over the interest rate minus 1 over interest rate times 1 plus the interest rate raised to the t power, okay? So here the C is the payment, the R is the interest rate, and this T here, the power, is number of payments. In this question will be 30, okay? We can use your financial calculator to calculate this, okay? So my recommendation is don't use that equation too much unless you don't have a financial calculator, okay? This equation takes longer to calculate, okay? In the test, in your homework, anything, okay? All right. Now, why do we want the present value of annuity? Why? Okay? I know. It's one of your requests. It's something you need to get an A. Sure. But why? Apart from that, why? Yes?
To see if certain investments are worth it.
Certain investments are worth it, okay. So what's the very meaning of this present value of this annuity here? It's the price of this annuity. When you want to buy an annuity, what should you pay? Right? Okay? Let's say if this comes out at $500, what does it mean? It means that this 30 years worth of cash flow is $500 today, total. Okay? And believe me, if you want to buy it, the seller also knows it. Okay? You know it's 500, they know it's 500. So what's going to happen? You don't want to buy it more than 500. They don't want to sell it less than 500. So the price of the asset is 500. You pay 500, they feel fair, you feel fair. Okay? I know you want to buy it at 350. They want to sell it at 1,000. But is that going to happen? No. You both know that it's going to be $500. The fair price is $500. You shouldn't buy it more than 500, and they shouldn't sell it less than 500. Okay? So to calculate the present value of the annuity is basically calculating the price, or the present value, right? The value of this annuity today. Okay? All right. There's another asset called annuity due. Annuity due is annuity starts right away. Okay? you can see that this annuity starts at the first year, but this annuity starts at the 0th year. Okay? For 30 payments starts today, it ends in 29th. Okay? Ends in 29th, not 30th. Okay? Generally, to calculate the present value of the annuity, this is the equation I like or prefer, is using 1 plus interest rate times the present value of the same annuity, but it starts at first year. Okay? So this annuity, if it's a very standard annuity, it starts in the first year and lasts to 30th, like this one. Okay? But this one is annuity due, which starts in the 0th year and lasts to 29th year. So to calculate the present value of this annuity, generally speaking, do this first, and then use 1 plus r times the present value of that annuity to get the annuity due. Okay? It's easier. Okay. So a perpetuity is a stream of cash flows that never ends. Okay? Annuity ends at some time. This is a 30-year annuity. Okay? But perpetuity never ends. It's a stream of cash flow lasts forever. Okay? To calculate the present value of annuity, okay, you're saying, what should we do? In principle, is infinite amount of cash flows discounted to today and added up. That's the principle. Okay? But mathematically, we have a beautiful equation that's calculating that, which is using what? Your payment every year divided by your interest rate. Okay? Okay. So a few things to notice. First of all, annuity or perpetuity. Excuse me. The payment every year is the same. Okay? If you have a stream of cash flow of different payments, you cannot call that annuity or perpetuity. Okay? The payment is the same. Okay? And it's because of the payment is the same, you can have this kind of equations here. Otherwise, which payment should you use? Right? Okay? Annuity ends in some year. Perpetuity never ends. Okay? All right. There's another big part of Chapter 5, which is talking about the effective annual rates and annual percentage rates, okay, EAR and APR. Okay? So if you ever have read your credit card information, okay, I believe you don't read those little items in your contract. They are very small founded, not good for your eyes, right? So you just sign your name and get a credit card, okay? But usually when you apply for a credit card, it says something as 24.99% APR or 30% APR. That's this APR, annual percentage rate. But does it mean that if you owe $100 on this credit card, you pay $30 at the end of the year? Well, not so much. That's a little trick they played. Okay? It's because of the effective annual rate. Yes, your APR is 30%. That means, okay, it's the interest rate that's annualized using simple interest. Okay? Which means under simple interest, 30% APR, you pay $30 a year by owning $100 on your credit card. Okay? But if we're using compounding interest, things are different. Right? You know, because simple interest and compound interest we had before, right? They generate different values. Okay? Simple interest, $6 a year, $6 a year. But compound interest, you earn interest, all interest. So when you're owning the bank or credit card company money, you're paying compounding interest. Okay? Now how much compounding it is? The compounding frequency on your credit card is daily. They collect an interest daily, or your interest accumulates daily. Okay? So how do we calculate that? So your effective annual rate can be calculated in this equation, where M stands for frequencies of the frequencies of your collecting. Okay? So for a compounded daily, 365. Okay? So how much difference does that make? Let's take a look. Okay. Fire it up. Okay, so let's use 30%, okay, as your APR interest rate on your credit card. Okay, so by compounding every day instead of every year, let's see how much that grows to. Okay, so 1 plus. Okay, we have the minus 1. Oh, sorry. Equal sign, yes. Okay, so by compounding and daily frequency, it's set 30% as your APR, but really after a year, it's 35%. Okay, they collect. Right? So when you're applying for a credit card, you see that $24.99 or 30% APR, they're actually collecting this much. Okay? For 30% APR, they're collecting 35 actually, if you owe me money for a year. Okay? It's compounded daily. So with a higher frequency of compounding, your EAR, effective annual rate, is usually higher than your APR. Okay? Annual percentage rate. Okay? Okay, now, we'll see some examples of this, okay, later in the questions. You will understand a little better, okay? Using the financial calculator, okay, this is your financial calculator, okay? The bottom section is a regular calculator, okay? Different operations and things, okay? The financial calculator functions are mostly up here, okay? You have a cash flow method, you have a 5-key method, okay? We'll go through that a little bit, okay? Okay, so in the 5-key method, there are 5 elements. The first one, N, is the number of periods. Okay, it's not number of years for every question because sometimes you have monthly instead of yearly. Okay, remember the calculator cannot tell it's a yearly or monthly. It's not that smart. It's only recording how many periods. If it's yearly compounded, okay, 30 years is 30 payments, is 30 periods, okay? But if it's monthly, then 30 years is what? 360 periods, right? It's 12 months a year, okay? So the number of periods is N times M. Well, N is how many years, and M is how many frequency or how many times each year, okay? So for annual compounding is 1. For semi-annual compounding is 2, and for quarter compounding is what? 4, and for monthly compounding is 12, right? Okay. The interest per year, or interest per Y, is the interest rate. It's expressed as percentage, not in the decimal points, okay? This one is the real percentage points. If it's 5%, put 5 there. Don't put 0.05 there, okay? Okay. So the interest is your APR divided by the M we had before. If it's a 10%, but it's quarterly compounding, it should be 10% divided by 4, which is what? 2.5%. Okay? The payment is the amount of any recurring, intermediate, or periodic payments. Okay, so here the payment has one thing, okay? The payment has to be the same, okay? If your payment is not the same, you cannot put a payment in this key, okay? So for an annuity or annuity, that's fine, right? Annuities payment are the same, okay? Later on in the bond chapter, you can see the coupon payments are the same, okay? But if your payments are not the same, you cannot use this function, okay? All right. Okay. One thing about the calculator is do not ignore the direction of the cash flows. Okay. The 5-key, okay, has a function built in that's balancing the inflows and outflows of your cash flow. So the direction of the cash flows matters, okay, in the 5-key. We'll see that later in the example. Let's continue with questions. Okay. The sum of $3,000 is deposited into account paying 10% annually. If $1,200 $6 is withdrawn at the end of the year 1 and 2, how much remains in the account at the end of the year 2? Okay? So when we're doing chapter 5 questions, okay, do not just do calculations. Do not just punch your calculators, okay? This is what's supposed to be in your mind first, okay? You deposit $3,000. You take $1,206 every year. And after you take that out in the second year, how much is left over? Okay? Interest rate is 10%. Let's take a look at the signs, okay? $3,000 deposited. I understand that for some of you, you think, oh, I deposited $3,000. That's a positive cash flow. But let's rewind a bit, okay? How do you deposit $3,000? You go to the bank account, you take out $3,000, and you put it on the account. Is that taking money out of your pocket or in your pocket? It's out of your pocket, right? You're giving the money to the bank. Well, you'll get it later, okay? So when you are withdrawing $1,206 every year, is into your pocket or out of your pocket? Into my pocket, right? I put $3,000 there. A year later, I'll go there and say, give me $1,206. Okay? Right? I put them back in my pocket. I leave, right? Okay? So if you want to do it in a very ordered, not in the calculator yet, we do what? Year 0, 3,000. Year 1 is 3,000 with the interest, but you withdraw this amount of money. Okay? With this amount of money, in the year 2, you earn some interest, then you withdraw again. Okay? All right. Then that's what? $1,097.04. Okay? So how do we do it on the 5 key? Now, remember that the 5 key, first you press the numbers, then you press the key. Okay? So for this question, okay, what do? There'll be 2 years, right? Okay? There'll be 10% interest rate. What's your present value of first deposit? 3,000. But remember to make it negative. How do you make it negative? Here, right? The plus negative sign here, okay? And that's your present value. And 1206, that's your payment. Then you press compute, future value. Okay? Is that sign correct? Yes, I still have that. I can withdraw that amount at the end of 2 again, right? So that's the amount left over in the bank. Okay? I'll do it again, okay, on the calculator. 2 as n, 10% interest. 3,000 as your present value. 1206. Okay? As your payment, right? You do that twice. Okay? Same amount. Then you compute future value. Okay? $1,097.40. The same as our calculation step. Okay? All right? Okay. So I leave the solutions and keys here, so for you to try later. Okay? What is the present value of annuity of $27 received at the beginning of each year for the next 6 years? The first payment will be received today, and the discount rate is 10%. Okay? So this is what? Annuity due. Okay? So how do we do with annuity due? We do the annuity first, then use 1 plus interest rate times the annuity. Okay? You can do 2 ways. Okay? The first way is use the equation. You will reach this number. Okay? $117.60. But remember, when you reach here, you're not done yet. Okay? That's the present value of the annuity. But here, this question is what? Annuity due. So you need to multiply another 1 plus 10% to that to reach $129.35, which is almost $130. The answer is A. Okay? So how do we do that on the calculator? So on the calculator, we still use the 5 key. Okay? But here, there's a little trick. Okay? The calculator can give you a function calculating beginning instead of end payments. So, but you have to set it up. So you press the second and press this payment. But remember, when you're pressing the second, which a second show up, it will realize the function above this key. Okay? Not this key itself. This key stands for payment, right? But if you press second and this payment, it gives you this little begin function, okay? So you press that, okay? The calculator will show end. That's your setting now, okay? So what you do is what? Second and set, okay? Now it's changed to beginning. And you will see a little BGN here, okay? Stands for beginning. If it's end, it's default, okay? It's beginning, that's set up, all right? So now you have the beginning setting. See, if you clear everything, you see the beginning, yes?
So that's because we're doing the annuity too, right?
What's that?
When you do the annuity too,
Yeah.
that's when you
Yeah, so for annuity due, it's beginning payments, right? Annuity gives you the payment every end of the year, right? But annuity due is beginning of the year. So we're doing beginning mode in this calculator, okay? So now, it has 6 years, right? Interest rate is 10%. Payment is 27. To you, there's nothing for future value, and we compute the value, okay? It's 129.35. You ask, why is it negative? The calculator's logic is this. You pay $129.35 today. You receive 6 payments of $27 starting from today. Okay? The calculator of the 5 key is a balance of cash flows. Okay? The in and out are balanced. In the present value, they're even. Okay? So if you put in positive incomes in the future, you will have a negative present value today. The negative present value stands for you have to pay this much to receive that much in the future. Okay? Or if you have a positive present value, that means you're receiving this much, but you have to pay later. Okay? All right. Okay, next question. So that's annuity due, okay? There's another type of asset which is called deferred annuity. A deferred annuity is annuity that the first payment does not start this year or next year. It starts later, okay? So when you're using the formula to calculate the value of the asset or present value of the asset, the value generated is 1 year before the first payment, okay? So what do I mean? So you need another extra step to bring it to the present. Yes? Okay, I'll show you that later. Okay, don't worry. Okay, in this question, all right? Okay, that's a good question because you have to always get rid of the beginning for your calculator. Okay, so let's take a look at this question, all right? Charlie Stone wants to retire in 30 years. He wants to have an annuity of $1,000 a year for 20 years after retirement, okay? Charlie wants to receive the first annuity payment at the end of the 30th year. Using the interest rate of 10%, how much must Charlie invest today in order to have his retirement annuity? Okay? Still, first thing first, let's draw out a graph showing these cash flows. Okay? That's that helps you a lot. Okay? So the payment of this annuity is first payment comes in the 30th year and it lasted 20 years. Okay? So 30th year to 49th year is 20 payments. Okay? If you don't trust me, you can count, okay, with your fingers or toes. Okay? 20, right? Okay. Comes in handy. Okay. Now, let's not worry about the calculator yet. Okay? So what I meant by that is if you use this equation, okay, the annuity equation, right, to calculate the value. Now the value comes out of that equation is not a present value anymore. It's only a present value if it's an annuity. It's a standard annuity. The first payment starts the first year. But for this annuity, the first payment starts in the 30th year, right? Okay, not the first year. You can still use this equation to calculate something of $8,513.56. Okay, I'm still plugging 1,000 every year, 10% of interest rate, and 20 periods of payments. But remember, either use this equation or the perpetuity equation. This value you calculate stands not at present automatically. It stands at 29th. But how do we know it's 29th? You don't have to know it's 29th. You only have to know it's always 1 year before the first payment. When is the first payment? 30th. What's 1 year before the first payment? 29. Okay? That's the general rule. Okay? Once you know that this value sits here, what do you do to bring it to present? You discount. Okay? That's one value. You discount it for 29 years. Okay? Right? So the equation you have now for deferred annuity does not give you present value automatically. It gives you the value that sits 1 year before the first payment. Okay? So why does it give you present value for standard annuity? Let me see. Why does this equation gives you the value when standard? Give you the present value when standard. You can still use this rule. When does the first payment come? First year. What's 1 year before the first year? 0 is now, right? Okay, that rule works as well. Okay, so when you're using this equation, okay, so this $8,513.56, okay, stands in year 29, not 30, not 0. It's 29. It's 1 year before the first payment. Okay, then discount it for 29 years, you will have $536.69, which is around $540. Okay, now if we want to calculate this on the calculator, okay, the calculator works in the same way. You input all these numbers. See, 20 payments, 10% interest rate, $1,000 payment every year. You don't have anything else in the future value. Your present value is a negative $8,513.56. Okay? The calculator does the same thing. It still gives you this value, which is 1 year before the first payment. Okay? Although I know it says present value, but it's not really the present value. Okay? It's a present value when it's standard annuity. But when it's not a standard annuity, it's not a present value. Okay? All right. So how do we do that on the calculator? So every time, check if your beginning is here. If your beginning is here, let's do this again, right? Second, beginning. Second, set. Then it goes back to end. Okay? Okay? So you have a 20. You have a 10. You have a 1,000. Let's say you receive at 0 future value. Okay? But remember, this $8,513.56 stands for what? A standard annuity's present value. But is that the present value now? Or a standard annuity? No. It starts at year 30. When annuity starts in year 30, that number stands where? 29th. Okay? 1 year before the first payment. Okay? Now we discount this value, okay, 29 times. Okay? So how do we realize this on the calculator? Okay? You can think of this as a future value, no payments. Okay? How much is the present value? So to do that, you can see, okay, let's just keep using this. This is 8513.56. Okay? Let's put it into the future value. Okay? There's no payment. It's 29 years of discounting. It's 10% interest rate. Oh, sorry. So A513.56. Okay? 0 payments, 10% interest rate, 29 years of discounting. Okay? $536.69. That's almost $540. Okay? Okay, any questions so far? Good? Okay. Okay. If there's a deferred annuity, there's a deferred perpetuity. Okay? Same concept. The perpetuity is deferred later, not paying at the first year, but paying some years later. Okay? So let's see an example. Okay? This perpetuity pays $400 every year for the rest of the universe. Okay? starts at the end of 10th year. Interest rate is 5%. How much is it worth today? The first payment starts in 10th year and on. So if I use this equation for perpetuities, payments divided by interest rate, okay, it does not give you the present value already. Okay, it gives you a value that sits 1 year before the first payment. When is the first payment? 10th year. What's 1 year before the first payment? 9th. Okay? If you use payment over R, $400 divided by 5%, you got $8,000. But that $8,000 is not at the present value already. Okay? It's in the 9th year. Sorry. So for that to be in the 9th year, we need to discount another 9 years to find the value of this perpetuity. Okay? So that value is $5,156.87. Okay? That value sits in the present. Okay? But the 8,000 sits in the 9th year. Excuse me. Okay? Yeah. Okay, let's move on. Assume the total expense for your current year in college equals $30,000. How much would your parents have needed to invest 21 years ago in account paying 5% compounded annual to cover this amount? Okay? This is a simple discounting question. Okay? To have $30,000 in year 21st, what's the amount need to be saved in year 0? Okay? What do you need to do? Discount 30,000 by 21 years. Okay? So $30,000 divided by 1 plus 5% to the 21st power, and $10,768.27 is the answer. Okay? All right. So let me show you again how to do that on the calculator. Okay? 30,000. Okay? No payments, right? You set aside one big chunk of saving, and that's it. Okay? Let it accumulate 21 years. Okay? 5%, 21. Okay? So this means you have to pay this much to receive 30,000 in 21 years. Okay? So the negative sign, okay, matches the positive later. Okay. Okay. Old-time savings bank pays 3% annual interest rate on the saving account. If you deposited $2,700 in the bank and leave it there, assume bank pays compounded interest. Okay? How much interest will you earn the first year? How much interest you will earn in the second year? And how much interest would you earn in the 10th year? How do we calculate interest? Interest is what? The saving before times interest rate, right? So the first year's interest will be what? Your year 0 saving times interest, right? Year 2 interest will be what? Year 1's saving times interest. So what you need to do is to find out year 0's saving, year 1 saving, and year 9's saving to get the interest for first year, second year, and 10th year, right? Okay? So I matched a little bit colors here for you not to get lost. Year 0 principal is how much you saved just now, $2,700, right? Times interest rate, okay? $81 for the first year's interest, okay? Year 1 principal is what? Is year 0 times 1 year of compounding, right? So you will have $83.43, okay? Interest for the 10th year should be using total savings at the end of 9th year, okay? Multiplied by the interest rate. What's your total saving at the end of 9th year? It's 9 years of compounding, right? I'm talking about the total amount. I'm not just talking about the interest amount, okay? So that will be $2,700 times 1 plus 3% to the 9th power, multiplied by another 3%. Okay? That will go to $105.69. Okay? All right? So the answer is C. Okay. If you have $20,000 in your account earning 8% annually, what constant amount would you withdraw each year to have nothing remaining at the end of 5th year? This question is saying, oh, I have $20,000 now. Now I'm start to withdraw my money. Okay? I withdraw a same amount every year, okay, to have nothing left over in the 5th year, okay? So you can have a few thinking about this question, right? So what I do first is, what if we don't have a financial calculator? What do? You can consider these 5 payments as what? One annuity that has a present value of $20,000, right? It's like saying, oh, you sold an annuity to somebody. You received $20,000 today, and you pay this person 5 times, right? Okay? You can either do that to reach the payment, which is $5,009.13, or you can simply use the calculator, okay, to do this. Okay? You have 5 payments, interest rate of 8%. You have an initial saving. You put 20,000 into the bank, okay? 0 for the future, and calculate the payment, okay? That's the same, right? But, okay? But one thing I want to tell you is that there's a meaning of what's going on, okay? Learning how to do calculator or calculations is not the purpose here, okay? You need to know that, yes, but we're doing finance, okay? I know that most of the time you might not need to understand the question to do this, because you just remember certain steps of doing what, okay? You see a number, you put it somewhere, okay? You accumulate 4 numbers, you get another one out, okay? That's easy, I know. But try to think about this payment schedule. Try to think about the question first, okay? That's my general instruction, okay? Learning the steps on the calculator is very important, but that's not the goal here, okay? All right, but still, you need to do the calculator to do the answer, right? $5,009.13, okay? All right. Okay. Okay. So now you have a different type of compounding. Your real estate agent mentions that homes in your price range requires a payment of $1,500. What's the next 2 words? Per month for 20 years. Now it's not per year, right? It's per month, 20 years, right? 1.25% interest rate per month. Okay? So what's the size of the mortgage with these terms? Okay? So $1,500 per month for 20 years. How many payments are here? 240, right? 20 times 12. Okay, that's the n times m we mentioned before, right? So in the calculator, you can do 12 times 20, which is 240, to put it as n, right? Monthly interest rate is 1.25, so we put 1.25 here. Okay? 0 for the future value, 1,500 for the payment, and then, okay? So we get this number, $113,913.42, okay? Here is a different kind of schedule, okay? It's different for us, not different for the calculator, okay? Calculator only records how many payments, how much payments, how much interest between each payment, okay? But for us, it's different, right? It's not years anymore, okay? It's month here, okay? Any questions about this? We're good? Okay. Okay, let me just keep going like this. At what rate must $400 be computed annually for it to grow to $16.40 in 10 years? Okay. So for this question, $400 compound interest in 10 years, you want to get $716.40. So what's the interest rate? Okay? So what do? We are looking for this key here, right? The interest. Okay? We have what? We have 10 years. Okay? Now, think about the signs, okay? You go there, you save 400. In 10 years, you want to withdraw $716.40. Okay? So your cash is an outflow for present. Okay? It's an inflow, right, for your future. Okay? If you put both negative signs or positive signs there, the number will not be the same. Okay? You don't have any payments in between, so Your interest is 6%. Right? Okay? Okay? Let me do it again, all right? 10 years. Okay? $400, that's in outflow because you're saving it today to get it back in 10 years. Okay? 716.40 is your future value. 0 is a payment. Compute. Interest. Okay. 6%. Okay? Remember, when you read that 6%, there is 6%. Okay? It's not 6. Okay? Remember the percentage sign. Okay? There's 100 times difference there. Okay? All right. Okay. Doing good. Okay, almost there. If you earn 8% per year on your bank account, how long will it take an account with $250 to double to $500? Okay? It's the same thing as before, double. Okay? But here, there's a little trivia here. Okay? The trivia is, in investment, we usually care about when our money doubles. Okay? So there's a rule of 72. Anytime you have an interest rate, the amount of time it takes your money to double is approximately, okay, I'm saying approximately, not exactly, okay? 72 divided by your interest rate. So here for this question, you have an 8% interest rate, okay? 72 divided by 8 is what? 9. So the approximate number of years that takes your money to double is 9 years. Here, the exact one is 9.01. It's very close, okay? That's a rule of 72, okay? Right? So if you want a quick approximate of how long does it take your money to double, that's what you do. 72 divided by the interest rate, okay? How much more is a perpetuity of 2,000 worth more than an annuity of the same amount for 30 years? Okay? Interest rate is 20%, cash flow at the end of each period. So the difference between a perpetuity and annuity, okay, of the same amount but ends in differently, right, is what? All the payments afterwards, right? For annuity, you stop here. That's it. Done. For annuity, you keep receiving, okay? But simply, we can calculate the value of the annuity and the value of the perpetuity and make a difference, okay? But you can notice here, the difference starts from the 31st year, right? $2,000 every year, forever. That sounds like a big number, but look at the difference here. It's only $42 today of a difference. Because in 30 years, that $2,000 is not so much worth, okay? Today, okay? Any questions? No? We're good? Okay. You're going to pay $800 into account at the beginning of each 20th year, 20 years, okay? This is at the beginning of each 20 years, right? The account will then be left to compound for additional 21 years. At the end of the 41st year, you will begin to receive a perpetuity from the account. The account pays 14%. How much will you receive each year from the perpetuity fund, okay? Lot of years, lot of compoundings, okay? If you just do it on your calculator, you'll easily make a mistake. So what do? You first need to draw a timeline of cash flows. Okay? That's always helpful. Okay? So the question says this, right? 20 years of putting money into your account, $800 each year for 20 times. Okay? It starts from the 0th year and lasted until the 19th year. Okay? But that's okay. The second important information is this generates a cash flow starting from the 41st year and ever. Okay? Okay? So now, you can do a lot of compounding, discounting. That's cool. Okay? But if you grab the essence of this question, what's the essence of this question? There's no free lunch. What does it mean? The amount you pay is the amount you are going to receive. Okay? You paid for 20, and you paid for 20 times. You will receive that amount later. That's like buying your retirement plan. Okay? Does anybody give you a free cent of value? No. Are you going to lose a free cent of value? No. Okay? How much you pay is how much you receive. But the difference is you pay today, but you receive later. Okay? You pay for the first 20 years. You receive at the end of the 41st year. Okay? So the essence is the present value of the annuity is the same as the present value of that perpetuity. That's the key to this question. And that's the key to most of these kind of questions. Okay? No matter what year it starts or ends, remember, the amount you pay is the amount you receive. There's no free lunch. Nobody gives you a 1 cent addition to your value. And you're not going to lose a cent over that. Okay? Amount you pay is amount you receive. That's a fair game. So once we notice that, it will be easier. Because to calculate this annuity due for the first 20 years, okay, we follow the equation, right? Value of the annuity times 1 plus r. That's the value of annuity due. This value is the same as this perpetuity's value. Okay? Now, how do we get the perpetuity's payments then? Okay? So let me ask you a question. We had this before. A perpetuity starts from the 41st year if I do the payments over r, right? Payment over interest. Where does the value stand? Starts for the first payment of the perpetuity starts 41st year, right? If I use the equation, which is payment over r, okay, this equation, where does the value stand? 1 year before the first payment. What's the first payment of this perpetuity? 41st year, right? So where does the value stand? 40th, all right? So in principle, the value I calculate from this equation, which stands at the 40th year, okay? If I discount that value to present, should equal to this, okay? The present value of your payment and later the amount you receive is the same, okay? So what do I do? Okay. My payment of my perpetuity should be what? Interest rate times future value of the 40th, okay? But your future value of the 40th is the present value of the perpetuity compounded for 40 years because they have the same present value, okay? Then you will reach the payment of that perpetuity, which is $160,000, almost. Okay. Now you see, playing with the calculator here does not help you resolve this question. Okay. I mean, it helps you to get to the result, but you need to think about this question. Okay. The key to this question is the present value of your paying should be the present value of your receiving later. Everything should be equal. Okay. I'm talking about present value. You could have different payments today. You could have different receivings later. But the present value of those two assets should be the same. Okay? Once you grab that, this question starts to become easier. Okay? All you have to do is match the values. Okay? All right. When comparing annuity due to ordinary annuities, annuity due annuities will have higher what? You'll have a higher present value because you multiply 1 plus r to the present value of the annuity. Okay? Because r is a positive number, right? Okay. The present value of annuity stream, $100 per year, is $614 when valued at 10%. By approximately how much would the value change if there were annuities due? Okay? I guess the first thing you react to this question is, oh, I'm going to find that how many years I'm going to calculate to. Well, you don't have to, right? Because the present value of the annuity due is 1 plus the interest times the present value of the annuity. Present value of the annuity is given, right? 614. Okay? So the addition to that is what? So you calculate 1 plus 10% times 614 minus 614. So the difference is what? $61.40. Okay? You don't have to go to the 5 key for this question, okay? Because there's an equation building the value of annuity and annuity due. Okay. This is another deferred perpetuity question, $500 every year, forever, starting from the 3rd year. Okay? So once you use the equation, okay, you have a value at the 2nd year, and you discount. Okay? Same thing as before. We good? No, I'll post this afterwards. Don't take notes. It's fine. Okay, listen to me talking. You will see this afterwards online. Okay, don't worry about it. Okay. So last part of this section. Okay, let's take 5 more minutes. What's the APR on a loan that charges interest rate at 2% per month? This is APR. This is simple interest. Okay, so it's 2% times 12, which is 24%. APR is simple interest. It's not compounded. Okay. Okay. What's the effective annual rate of interest of 14.5% a year using semi-annual payments? Okay. By equation, you have this. Your APR divided by 2, which is semi-annual payments, raised to the second power minus 1 is your EAR. Okay. So if you use your calculator just normally, you will have 14.1%. But there's another function on the calculator that you can use to do effective annual rate, okay, and the annual percentage rate. Okay. It's this function called interest conversion. Okay. So let's try that. Press second and press interest conversion. Now you're in this mode. Then scan through it using the down button here. You can see 3 items, okay, which is nominal, effective, and frequency or compounding. Okay. So for this question, for example, you have an effective of 14.5. Okay, so enter 14.5 and press enter. It's not pressing equal, it's pressing enter. Okay, you have a frequency of what? 2. Then you compute the normal or nominal. Okay? Okay, so let me do it again. Okay, second conversion. Okay, you're in this mode. You have 3 items: normal, effective, and this stands for the frequencies. Okay. In our question, we have what? Effective, which is 14.5. You press 14.5. You don't press equal here. You press what? Enter, for the calculator to register this number. Okay. Frequency is 2. Okay, and then reach the normal screen and press compute. Okay, when there's a little star, it says, oh, this number is being computed. Okay, if you don't clear your numbers, your last time's number is still there. So don't trust those numbers. Okay. 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 If you have a 6% compounded 6% annual rate compounded quarterly, what is your effective rate? Okay. You can do it 2 ways. This is the one of the way: 6% annually divided by 4 times, which is quarterly compounding, raise it to the 4th power. Okay. Or you can use a calculator, which is now it's nominal 6%. Sorry. Frequency is 4. And then, for the effective, hit compute. Okay? Okay? 6.14% effective. Okay. Okay. Oh, sorry. This should be EAR here. Okay? I'll change afterwards. Okay? In this question, you compute 2 EARs from 2 investments. Okay? Because remember that although I know it's 2 terms, EAR is called effective, which is actually how much amount earned or received or paid. Okay? APR is a notation. Okay? If it's APR 10%, okay, quarterly compounded, the real investment return is 10.38%. Okay? Although it's denoted as APR, it's really earned as EAR, just like a credit card. It says 30%, but it's actually 35% if you're really paying for that. Okay? So compare the 2 EARs. Sorry, this should be EAR. Okay? And you pick the higher one, right? Okay. Do I have this one? Okay. This is a infrequent or irregular cash flow question. Okay? You have 3 cash flows: 200 the first year, 100 the second year, and 150 in the third year. Okay? You have an interest rate of 6%. Okay? So if you want to calculate the present value of this, you can calculate the present value of each one of them and add them up. Okay? But how do we do it in a calculator? Remember, for the 5 key, you cannot do that because this payment has to be the same for the 5 key to be used. Okay? So how do we deal with irregular cash flows? There's another function on a financial calculator, which is the cash flow. You press the cash flow, you can enter every cash flow every year into the calculator. Okay? This is cash flow 0, it's 0. Okay? Cash flow number 1 is 200. Enter. This F stands for frequency of the first cash flow. Okay? So we have one $200, one $100, one $150, right? Okay? So frequency of cash flow 1 is 1. Cash flow 2 is $100. Frequency is 1. You have $150 for cash flow 3, and frequency of cash flow 3 is 1. Now, we have entered all the cash flows. Okay? You can press this down button again multiple times to check your cash flow entries if they are correct. Okay? Once you confirm the cash flows are correct, press the NPV here. Now it's time to put in your interest. How much interest are we having here? 6%. So put 6, the same as the 5 key. Okay? Don't put 0.06. Remember to enter here. Do not just put a 6 and scroll. Okay? Okay? Every number you put in, you hit enter, you will see this little triangle here. That's when the calculator registers the key. Okay? Press down button, and now it's NPV, right? So we press compute. Okay? So the 3 cash flows total is $403.62. Okay? Okay. Same type of question, right? I will leave that to you. Okay? If you don't get the sequence, key sequence, don't worry, okay? It's recording. Okay? You'll see that later online. Okay? Okay, how many more? I have one more, yes. Okay? If the interest rate is 5%, which of these investments would you prefer? This is a tricky question. It looks like one question, but it's actually 4 questions. Because you need to calculate 4 present values and compare. It says, would you prefer? What kind of investment would you prefer? You prefer a higher present value. Okay? So in order to get this question, you need to get 4 present values out of those. But, okay, you have seen those assets before. The first one is ordinary perpetuity of $30. So the present value of the first one is what? Payment over R, $600. Second one is a present value given. Okay? Great. No need calculations. Third one, a single payment of $500 at the end of first year. So you need to discount the $500 for 1 year. Okay? So $500 divided by 1 plus 5% to the first power, which is 1.05. Okay? $476.19. The last one is a payment of $50 a year for 20 years, starting in 1 year's time. This is a $50 of annuity for 20 years. Okay? So you can do, and it's 20, interest is 5%, payment is 50, no future value, and the present value is $623.11. Okay? So the last one has the highest present value. Okay? I also give you a note of how to do that, okay, by yourself. All right. Thank you for your time. Okay? I believe the next review session is in November. So if you still want to come, okay,